Inflation has turned out to be much more persistent and stickier than many market participants believe possible. There are reasons to believe that above-trend inflation could be with us for the next few years. With governments issuing more debt, this may put pressure on central banks to monetize that debt. We've seen it before. It's called quantitative easing. The net result is an increasing money supply, which creates the necessary conditions for inflation. More dollars chasing the same or fewer goods. Slow transition to renewable energy. It's possible, even some say likely, that we will see a peak in fossil fuel supply before we see a peak in fossil fuel demand. If this happens, it will result in continued upward price pressure on fossil fuels as we go through this transition to renewables. And to be clear, this could last for up to 10 years, some say even longer. The war in Ukraine is putting price pressure on energy and food. And it's not just affecting Europe. Those price pressures reverberate around the globe. Investors need to take steps to lessen the impact of inflation on their portfolio. Investors can seek to include exposure to assets like a broad basket of commodities in order to further diversify what is traditionally a portfolio that's heavily weighted to equity and fixed income. Commodities have a high beta to unexpected inflation. So if we experience rise in inflation, commodities are expected to do well. In the first half of 2022, when equity and fixed income markets were down significantly, commodities were up about 18%. Second, smart approach to fixed income. Now, we understand the need for investors to have fixed income, provides diversification versus traditional portfolios, traditionally growth assets like equity, but it also provides income. However, static bond portfolios, fixed income ETFs, and fixed income mutual funds that track common benchmarks can expose investors to excessive interest rate risk and shifting returns in a rising rate environment. We'd suggest investors consider a laddered fixed income approach with evenly weighted maturities that has bonds rolling out of their target range and sold or maturing on a regular basis. In a rising rate environment, proceeds can be reinvested at higher yields, thus providing some protection for the portfolio. Finally, embracing volatility. In a high inflationary environment, investors need to earn a higher return just to stay even. The volatility risk premium is what investors are paid for providing protection against, most commonly, equity market volatility. Ongoing and reoccurring inflation tends to coincide with increased equity market volatility. Investors are trying to figure out what companies can protect their margins from rising costs. As market volatility rises, so does the demand for protection from it. Investors need to monetize the volatility risk premium either on a standalone basis or as part of a broader portfolio. Inflation may very well end up being something we're dealing with for the next several years. Investors need to be prepared for this environment.